Welcome back to Investing Talk Podcast. Today, we are taking a close look at a really interesting name in automation, Richtech Robotics. The main thing we're trying to figure out for you, the listener, is this. Is now actually a good time to buy into this high growth, but high risk robotics stock? It's a real clash between huge current losses and these massive growth forecasts. And before we jump into all that, hey, if you like what we do, please subscribe, maybe give us a like. And seriously, if there's a company you want us to analyze next time, just drop it in the comments below. We do read them, and it helps us plan future analyses.
It's a great one to look at because it's just so polarized right now. I mean, the information we've gathered really shows that split. You have fundamental forecasts talking about explosive revenue growth.
Right.
And some pretty bullish technical charts, too. But, and it's a big but, that's all happening while the company is, frankly, losing a lot of money. So our goal here is to kind of sift through these mixed signals and give you a clear, structured view of what the investment case looks like.
Okay, let's start right there with that fundamental contradiction. Because looking at the recent numbers, specifically Q2 2025, well, things look pretty rough. Revenue came in at $1.18 million. That's actually down 18.4% compared to last year. And it missed what analysts were expecting.
Yeah, missed the $1.42 million estimate. And honestly, that's not even the number that jumps out the most.
Wow.
No, the sources point to a net margin that's...
Oh, minus 366.21%.
Wow, minus 366%. That's,
Yes.
yeah. For anyone looking at the bottom line, that's a huge red flag.
It really is a hard stop for many investors.
Absolutely. So, okay, this makes me skeptical. If performance is actually declining year over year right now, how on earth do analysts justify this projected boom? We're seeing forecasts jump to $5 million revenue for the full year 2025.
Which is already a big step up.
Right. And then this massive leap to nearly $13.5 million for 2026. I mean, is that based on anything solid or is it just hope?
Right.
Well, the argument is it's based on execution and the kind of business they're building. That $13.48 million figure for 2026, that represents like 175% sales growth.
175%.
Yeah, it's aggressive, definitely. But it signals that the market believes demand for their specific automation tools is about to really take off. It's an inflection point bet.
But still, how does the market justify the current market cap? It's around $954 million, right? For a company losing so much money.
Okay, so this is where the interpretation comes in. According to GAAP, yes, the trailing 12-month net income loss is about $15.12 million.
$15 million loss.
Right. But crucially, the sources suggest the market isn't just seeing that as a loss. It's viewing it more like an asset acquisition cost.
Asset acquisition. Explain that.
They're spending that money, that $15 million, on heavy R&D, on building out their sales teams and infrastructure, basically laying the groundwork needed to actually achieve that 175% revenue jump they're forecasting.
Okay, so it's the cost of buying future growth, future market share.
Exactly. And the view that kind of supports that big valuation is that these losses, the EPS losses, are actually projected to narrow from about negative 15 cents a share now down towards negative 10 cents by 2026.
So the bet isn't on today's sales.
Not at all. It's on stabilization, improvement, and the success of that 2026 product pipeline.
Okay, if you're betting the whole farm on scaling up like this, then their products better be pretty special to justify taking on this much risk. It can't just be about selling more, right? They need some kind of technological edge, a moat.
That's precisely the thinking. That high valuation really implies that analysts believe Richtech Robotics does have proprietary tech, something that keeps customers locked in, hopefully leading to high-margin, recurring revenue down the line.
And they offer these end-to-end solutions, right? Tailored for specific industries.
Yes, exactly. Focused on high-demand service verticals.
So what stands out in their product lineup? I mean, I see Adam, the AI robot barista. Kind of flashy, gets attention.
It does get attention, yeah. Like a visibility product.
But I'm personally more interested in something like MedBot.
MedBot is really key, I think, because it targets healthcare delivery. That's a sector often willing to pay more for reliability and for genuine operational savings.
Makes sense.
And you combine that with Scorpion, their autonomous cleaning robot, and MyTradey for general service tasks. It shows their strategy is really about cutting labor costs for their clients.
So the competitive edge is being early with a whole suite of tools, not just one robot.
Right. Early, comprehensive, and tailored. They also have Titan for heavy logistics, Skylark for customized hotel services. It's broad within the service sector.
It sounds like they're trying to embed themselves deeply into how their clients operate. Like once you set up Medbot or Scorpion in your hospital or hotel.
It becomes really hard and expensive to rip it out and replace it.
Right. That operational reliability becomes the moat.
That's the idea, and that's what analysts hope justifies the market cap. Plus, you see the company deploying all its cash for growth, no dividend. It confirms management is totally focused on this scale-up plan.
Speaking management, insider ownership is high, right? Over 25%.
Yeah, 25.70% held by corporate insiders. Usually that's seen as pretty bullish, skin in the game.
But we do have to address the recent insider activity. The COO, Phil Zhang, he sold 100,000 shares back in September. It sends a bit of a mixed signal, doesn't it?
It does raise a question about conviction, absolutely, especially with those big losses we talked about. However, digging into the source material, it doesn't look like he's abandoning ship.
Oh.
Even after selling those 100,000 shares, he still holds 1 million shares.
1 million. Okay, that's still significant.
Yeah, worth over $5 million at recent prices. So while, yes, 100,000 shares is a decent chunk of cash out, his overall financial interest is still very much tied to the company doing well long term.
So maybe more like mixed conviction or just taking some profits rather than a sign of panic?
That seems to be the read. Still aligned, mostly.
Okay, let's pivot then. Let's look at the stock chart because the technical picture, well, it tells a story that investors have been buying into that future growth narrative, not the current reality.
Definitely.
The stock's had a heck of a run. From a 52-week low, just $1.52.
Amazing climb.
Up to a recent high of $7.43. Even now, trading in the, $4.69 to $5.36 range, that shows some serious momentum.
Absolutely. That's a strong technical signal. And the price is staying consistently above key moving averages.
Right, the 50-day and the 200-day.
Yeah, the 50-day is around $4.13, and the longer-term 200-day is way down at $2.77. Trading above both, this usually indicates a pretty solid bullish uptrend is in place, for now at least.
And the momentum indicators seem to agree, ADX and STOCH.
They do. The sources show the ADX, which measures how strong the trend is up at 41.76. That's considered very strong. And the STOCH oscillator, another momentum tool, is giving a buy signal at 16.55.
So technically speaking, looks pretty good.
Technically, yes, the momentum is clearly bullish. But, and here's the but, again, this picture comes with a major warning label. Volatility.
The beta.
Exactly. The reported beta is high, 2.31. So for listeners, what that means is if the overall market drops, say, 1%, Richtech Robotics could theoretically fall about 2.31%. It amplifies market moves.
And I saw one source even reported a beta of negative 4.14 recently. That sounds incredibly volatile.
It highlights just how wild the swings can be. This is not a stock for the faint of heart. You really need to buckle up if you're trading this one.
That volatility seems perfectly reflected in the analyst ratings, too. They're all over the place.
Completely divergent, yeah.
You've got H.C. Wainwright upgrading, saying strong buy with a $6 target, clearly buying into that growth story.
Focusing purely on the future potential, ignoring current losses.
But then you have others like Wall Street Zen, Weiss Ratings, issuing sell ratings.
Right, and those sell ratings are likely coming from analysts focused on value metrics, looking at the current lack of profitability, the high valuation relative to current sales.
So the overall consensus ends up being more like a hold, with an average target around $4.50.
Exactly. That divergence tells you everything about what kind of investment this is right now. It's a momentum and growth story, not a value play. The analysts are split based on which lens they're using.
Okay, so we have the bullish technicals, this huge growth thesis,
yeah,
but also these clear warnings on volatility and the current lack of profit. Looking ahead, say, the next 3 months, what are the make-or-break events? What could push the stock higher or trigger a big correction?
The absolute biggest one, no question, is the Q4 2025 earnings report. It's expected around December 3rd.
That's soon. Okay.
Yeah. And that report is critical. It's the first real test of whether the company is actually starting to bridge that huge gap between where sales are now and where they need to be for that 175% growth projection in 2026.
So investors will be looking for strong year-over-year revenue improvement, something to show the ramp-up is actually happening.
Precisely. They need confirmation that the growth story is starting to play out in the numbers. If not, well, given the volatility.
Yeah, could get ugly. What else besides earnings?
Well, there are scheduled new product launches, potentially in those key hospitality and healthcare areas we talked about. Those could grab headlines.
Any big contract wins announced there could be huge.
Definitely. And don't forget potential institutional flows. Things like the Russell Microcap Index rebalancing in November. Sometimes that can provide a bit of a technical tailwind if the stock gets included or its weighting increases.
And then there are the rumors.
Ah, yes, the speculative side. Our sources mention unconfirmed talk, whispers really, about possible strategic partnerships, maybe with large hotel chains.
That would be massive for recurring revenue.
Huge. And also some speculation about potential government contracts. Again, totally unconfirmed, but if anything like that were to actually happen,
the stock could move very quickly.
Very quickly. But you can't invest based on rumors alone.
Of course not. So lots of potential upside catalysts, it sounds like. But the risk always comes back to execution, doesn't it? If they miss on that Q4 report, or just struggle to scale effectively, what's the biggest danger for investors?
The number one risk is still profitability and just basic execution. Can they actually manage this massive scale-up efficiently?
Right.
Because with that high beta, if they miss targets, the market reaction could be swift and severe. Sentiment is fragile here. And remember, even though Richtech has had early success, this is a fiercely competitive sector.
Lots of other companies trying to automate services.
Globally, so they need to keep innovating, keep that tech edge, but also manage that high R&D spending. It's a tough balancing act.
So the core risk boils down to missed targets could lead to sharp sell-offs because the stock is already volatile and maybe not super liquid.
That sums it up well. It's a race for market share, it costs a lot of money, and any stumble could be punished hard by the market.
Okay, let's try to bring this all together then. Recapping the core investment idea from our source material. The overall lean seems quite bullish, actually, like a 9 out of 10 bullish rationale among the growth-focused analyses.
Yeah, the bullish case really rests on 3 pillars. First, that massive projected revenue acceleration, that 175% number. Second, the technical picture looks strong right now, price above key averages. And third, you have that decent insider alignment heading into these really important Q4 catalysts.
And the sources seem to suggest it could appeal to different types of investors.
Right, maybe short-term traders playing the run-up into those December earnings, but also potentially long-term investors who really believe in the whole automation megatrend and are willing to bet on Richtech being a winner there.
It really is the definition of a high-risk, high-reward situation.
Absolutely, and it all comes down to whether Richtech Robotics can actually deliver on those huge promises and close that gap between today's deep losses and tomorrow's projected growth. So the final thought for you, the listener, is really this. Are the unique products like MedBot and the others and the current market momentum strong enough to make you invest in a company that, right now, has a net margin of negative 366%?
Yeah.
Answering that question, weighing that risk against the potential reward, that tells you if this specific, very aggressive growth play fits within your own investment strategy and risk tolerance.
That really is the critical calculation in these kinds of high-growth tech stories. Well, thank you for joining us for this analysis of Richtech Robotics. Be sure to look for future episodes of Investing Talk podcast right here.